Hi, welcome to my channel, Second PUC Accountancy. Learn, understand, and excel. Today, under admission of a partner, we are going to see yet another sum under the goodwill treatment where the goodwill is brought in cash and retained in business with a different adjustment. So, this is a second sum we are going to work out under this goodwill treatment. Now, let us see the sum under this. Rekha and Surekha are partners in a firm sharing profits and losses in the ratio of 3 is to 2. Their balance sheet is given below. So the balance sheet is given as 31st March 2024. Let's see the entries which are given on the liability side. Creditors 18,000, outstanding salary 12,000, reserve fund 10,000, and the capitals of the old partners, that is Rekha 60,000, Surekha 40,000. Total capital is 1 lakh. And now moving on to the asset sides, cash at bank 20,000, sundry debtors we have 25,000. There is a old PDD that is deducted 2,000. So the debtors in this balance sheet is 23,000. Next we have stock 7,000, furniture 25,000, buildings 50,000, profit and loss account 15,000. Now first let's see where these particular entries given in the balance sheet will appear. All the balance sheet entries we have to see now on the liabilities side. Creditors will go to the new balance sheet. Outstanding salary also will go to the new balance sheet when we prepare. Now this reserve fund will go to the partner's capital account, and it is the reserve fund created by the old partners. So it goes to the old partners capital account, must be distributed to the old partners in their old profit sharing ratio. Then next we have capitals. Capitals of Rekha and Surekha again will be entered in the partners capital account under Rekha's account 60,000 and Surekha's account 40,000. Now moving on to the asset side, cash at bank will appear in the new balance sheet but with certain adjustments. Then next we have sundry debtors again will appear in the new balance sheet with a PDD adjustment. Stock also will appear in the new balance sheet. Furniture will appear in the new balance sheet. Buildings will appear in new balance sheet, and this profit and loss account which is given on the asset side is considered as a loss. So therefore it will go to the partners capital account and it will be distributed to the old partners in their old profit sharing ratio on the debit side of the partners capital account. So that's how these entries have to be transferred to the partner's capital account and other entries to the new balance sheet. Now moving on to the adjustment here. The adjustment we have are on 1st April 2024, they admit Chandrika as a new partner into partnership on the following terms. First adjustment says that Chandrika brings in 40,000 rupees as capital and rupees 20,000 towards goodwill for 1/4 share in the future profits, and this goodwill should be treated as per AS 26. The second adjustment we have is depreciate furniture by 10% and buildings are valued at 45,000 rupees. The next adjustment, PDD, this is the new PDD which is given in the adjustment. It says that PDD is increased to rupees 3,500. The next we have is prepaid insurance. That is the insurance which is paid in advance, that is rupees 2,000. So we have to prepare revaluation account, partners capital account and the new balance sheet as on 1st April 2024. Now before we could prepare the accounts, first let's see the adjustments given here. So what is the information given as per the question? The old ratio is given as for Rekha and Surekha 3 is to 2, that can be written as 3/5 and 2/5, which will be used to distribute the profit or loss and the accumulated profits and losses. And the new partner's Chandrika's share is 1 by 4. Now, here we know that the goodwill has to be treated as per AS 26. So, the goodwill treatment should be distributed to the old partners, which is brought in by the new partner in the sacrifice ratio. Since there is no other information regarding the new profit sharing ratio given to us or sacrifice ratio given to us in the question, the old ratio itself will be the sacrifice ratio. So sacrifice ratio between Rekha and Surekha will be 3:2, that is 3 by 5 and 2 by 5, which is same as the old ratio. Now moving on to the adjustments given here. Now regarding the first adjustment, Chandrika brings in 40,000 as capital and 20,000 as goodwill, and the goodwill remains in the business. It is retained in the business. So Chandrika's capital 40,000 and goodwill she brings in rupees 20,000. Total 60,000 rupees is brought in by Chandrika, which should be recorded on Chandrika's capital account on the credit side. And assume that this amount is brought in terms of check. Why? Because in the balance sheet it is given as cash at bank. When they mention bank, treat all the cash treatments in the bank account. So therefore, the total cash rupees 60,000 should be written on the credit side under Chandrika's capital account as bank account. Next, treatment for goodwill. The goodwill amount rupees 20,000 which is brought in by the partner should be distributed between the partners, that is Rekha and Surekha, in the sacrifice ratio 3:2 as per AS 26. So how do we distribute it? The goodwill rupees 20,000 should be distributed to the old partners in their sacrifice ratio, which we will see when we prepare the partners capital account. Now moving on to the next adjustment, as per the adjustment here B, that is depreciate furniture by 10%. So depreciation of furniture 10%, calculate 10% on furniture, that is given in the balance sheet 25,000. So 25,000 into 10% will be 2,500. Now this is decrease in the asset furniture. So how do we treat it? Any adjustments, it will appear in two places. It will appear in the revaluation account as well as in the balance sheet. So first, this decrease in the furniture 2,500 should be recorded in the revaluation account debit side, and then it should be recorded in the balance sheet. On the asset side, it should be deducted from the furniture because it is decreasing. The next adjustment, let's see the next adjustment, that is buildings revalued. That is the second part of B. Buildings are revalued at rupees 45,000. Now here they have given a new value for the buildings, that is 45,000. So we should find out whether the buildings value has increased or decreased. So let us see here, balance sheet value given here as for buildings is rupees 50,000 and the adjustment revalued amount is 45,000. So when we compare these two, we can see that the new value has decreased. So therefore it is a decrease in the buildings, and how much it is decreased? Rupees 5,000. So what is the treatment here? First, we have to record it on the debit side of revaluation account, and secondly, in the balance sheet, we have to deduct it from the building on the asset side. 5,000 rupees should be deducted from the buildings on the asset side. Now, the next adjustment, what we have is PDD. It's a very important adjustment. PDD here is increased to rupees 3,500. So they have not given us the percentage, but they have given that the PDD is increased to rupees 3,500. Now this PDD which is given here, it will be treated as a new PDD, which is going to be deducted from or decreased from the debtors. But we also have a PDD in the balance sheet, that is 2,000 rupees, and this is considered as the old PDD. So now we are going to compare the old and the new PDD given in the adjustment. So existing PDD which is given in the balance sheet is 2000, and we have to deduct the PDD which is given in the adjustment, that is 3500. Now this is a loss. Now when we compare these, the new PDD that is given in the adjustment is greater. That means our expenses or loss is more than the old PDD. So there is an increase in the loss, or we can call it as decrease in the asset. It is increased by 1500. So how do we treat it? It again should appear first in the revaluation account on the debit side, and secondly in the balance sheet we will deduct it from the debtors on the asset side. Now the next adjustment what we have is the prepaid insurance. Prepaid insurance is rupees 2000. So this prepaid insurance refers to the insurance which is paid in advance by the firm. So it is an expenses which is paid in advance, which is not our expenses now. So it is treated as a asset. Still it is not our expenses for the firm. So how do we treat it? First, it should be recorded in the revaluation account on the credit side, because it is a increase of assets. So it is not our liability still. So, or we can call it as decrease of our liability. Then the second step, we will write it on the asset side of our balance sheet. Since it is still not our liability, we write it on the asset side of the balance sheet. So this is the treatment for the adjustments given here in the question. Now let us see how to prepare the revaluation account with the given adjustments. Moving on to the revaluation account. So this is the format of the revaluation account. Now here in the revaluation, as per the adjustments given for us, first we have the furniture that is being depreciated. So it will appear on the debit side, because on the debit side we record all the decrease of the assets and increase of the liability. So furniture decreased or depreciated will be on the debit side, rupees 25,000 into 10%, 10 by 100, that is 2,500. Next adjustment what we have is the revalued buildings. Now when we compared in the adjustment, we saw that the building's value has decreased in the adjustment. So therefore it is a decrease of the asset. So it will appear on the debit side of revaluation account. Debit side of revaluation account, we have to compare it and write the amount, that is 50,000 minus 45,000. So when we deduct it, the balance amount is rupees 5,000 on the debit side of revaluation account. Now next adjustment what we had is the PDD, that is the increase in the PDD. So therefore this also will appear on the debit side as it is a loss, as 2 PDD. On the debit side we have to write it. We deduct 3,000 rupees minus 2,000, that is the amount given in the adjustment minus the amount which is given in our balance sheet. So the PDD has increased by 1,500 on the debit side. Now next what we have is the insurance prepaid. The insurance prepaid. So insurance prepaid is a income for us, or we can say it is a increase of our assets. So it will appear on the credit side of our revaluation account by prepaid insurance 2000. Now once these entries are being done, now we have to balance it. Now if you see the balance here, debit side is 9,000 and credit side is 2,000. So we are going to write only the higher total, that is 9,000 on both the sides. Now if you see debit side is more, that is our expenses or losses are more than the income. So it is a revaluation loss. So the balance should be 9,000 minus 2,000 we will get a balance, which is the revaluation loss, which should be again transferred to the partner's capital account. So it should be transferred to the partner's capital account. 7,000. 9,000 minus 2,000 is 7,000, and this 7,000 should be distributed to Rekha and it should be distributed to Surekha in their old profit sharing ratio. That is 7,000 into 3 by 5, that is the old ratio. So Rekha will get 4,200 and Surekha will be 7,000 into 2 by 5, that is 2,800. So this is the loss which has to be borne by the old partners. So this is the revaluation account, what we have got here, that is the loss. Now this should be transferred to their partner's capital account. Now we will move on to see the next account, that is the partner's capital account. So this is the format. We have three partners. So debit side and credit side, we have to write all the three partners. So first we have to bring down the balance, that is the capital of the old partners. They have given the old partners capital, which should be brought down to the credit side of the partners capital account as by balance brought down. The capital is for Rekha 60,000 and for Surekha 40,000. Okay, now once we have brought down the balance, we have to bring down first all the entries that are related to the old partners, because what they have created should be brought down to the partners capital account. Next, they have created reserve fund. So reserve fund belongs to the old partners, so it should be distributed to the old partners before admitting a new partner. So the reserve fund given in the balance sheet is rupees 10,000, which should be distributed to the old partners in their old profit sharing ratio, that is 3:2, which will be 10,000 into 3 by 5, that is 6,000, and 10,000 into 2 by 5 will be 4,000 for Surekha. Now, if you notice here, there is a profit or loss which is given in the balance sheet. Now, which is given on the asset side. So, therefore, it is a loss, accumulated loss. Now, this accumulated loss should be recorded on the debit side of partners' capital account. The loss has to be borne by the old partners. It is the loss of the old firm. Loss of rupees 15,000 should be distributed to the old partners in their old profit sharing ratio, that is 3:2. So 15,000 into 3 by 5 will be 9,000 for Rekha, and 15,000 into 2 by 5 will be 6,000 for Surekha. So we have distributed all the entries to the old partners. So now next we have to distribute the revaluation account balance. Now here we got revaluation loss. So loss on revaluation again should be distributed to the old partners on the debit side. So the loss we had already distributed in the revaluation account. So for Rekha it is 4,200 and for Surekha it is 2,800. So all the entries related to old partners are being brought down now. So now moving on to the new partner Chandrika. Chandrika brings in capital and goodwill in the form of cash and it is retained in the business. So here we are going to treat the capital and the goodwill brought in the form of check. As in the balance sheet it is given as cash at bank, we treat it as check. So bring down the goodwill and the capital which is brought in by the new partner as by bank account. So she brings in capital 40,000 and goodwill 20,000. So total 60,000 under Chandrika's column. Now here Chandrika brings in 20,000 as goodwill. Now this goodwill is brought in by Chandrika for the old partners for their sacrifice. So we are going to distribute Chandrika's goodwill which is brought in to the old partners in their sacrifice ratio. So we are going to write it as by Chandrika's capital account. So goodwill amount rupees 20,000 should be distributed to the old partners in their sacrifice ratio. So here the old ratio itself will be the sacrifice ratio. That is 20,000 into 3 by 5 will be 12,000 for Rekha, and 20,000 into 2 by 5 will be 8,000 for Surekha. So this is the goodwill which is brought in by the new partner distributed to the old partners. Now, since this goodwill is distributed from Chandrika to the old partners, it should be deducted from Chandrika's account because she is giving it to the old partners. To reduce the amount from Chandrika's account, we are going to write the entry on the debit side. So that is Chandrika gives to Rekha, so write on the debit side to Rekha's capital account. So goodwill which is given by Chandrika is 12,000, and for Surekha she gives rupees 8,000. So the amount what is being distributed for Rekha and Surekha on the credit side should be deducted from Chandrika's account. So we record it on the debit side. Now, once the entries are all done, now we have to balance the account. So get the total of the capital account. Now we have to see what is the total of Rekha, that is 60,000 plus 6,000 plus 12,000 will be 78,000. So right here that will be the highest total, 78,000. So this will be the highest total which has to be entered on both the sides of Rekha's account. Total Surekha's account 40,000 plus 4,000 plus 80,000 will be 52,000. Again here credit side is higher, so we are going to write it on the credit side amount 52,000 on both the sides. And for Chandrika it is 60,000, so write 60,000 on both the sides. So when you see the credit side is more and the debit side is less, now we have to deduct this total from the debit side total. So 78,000 minus the debit side total, that is 13,000 for Rekha, and for Surekha it is 52,000 minus Chandrika will be 60,000 minus 20,000. So the balance here will be on the debit side as two balance carried down, 64,800 for Rekha, 43,200 for Surekha, and 40,000 for Chandrika. And this balance is called as the new capital, which we are going to transfer it to the new balance sheet. And this is the capital which will be taken forward for the next financial year. So we are going to bring it down on the credit side as balance brought down. Okay, so we are going to show it as balance brought down. So it should be brought down to the credit side of partner's capital account to show that it is the opening balance for the next financial year. So this will be the new capital for the partners, which will be transferred to the new balance sheet. Now next we will move on to see final statement, that is the balance sheet of the new firm. So write the heading as on when the partner is being admitted. The new partner is admitted on 1st April. So write it as 1st April. So balance sheet as at 1st April 2024 will be given as below. So you will have assets and the liabilities. So first, as per the problem given to us, write the entries as it is from the old balance sheet, but incorporate the adjustments. So first we'll take the cash at bank on the asset side. So take the cash. So here, so now we have to write the cash at bank. So here we have to add the cash at bank, which is given in the balance sheet, plus the amount that was brought in by the new partner, Chandrika's, Chandrika's capital, plus the goodwill which is brought in by Chandrika should be added together. So which will be 20,000 plus 40,000 Chandrika's capital plus 20,000 is the goodwill. So total amount will be 80,000. This is the cash which we have to bring it to the balance sheet with the adjustments. Okay, now once the cash entry is done, the next entry we have is the sundry debtors. Now sundry debtors are to be adjusted with a new adjustment, that is debtors is 25,000. From the debtors we have to deduct the new PDD, that is 3,500, which is given in our adjustment. Since the PDD has increased, so the balance amount which has to be recorded on the asset side will be 21,500. Next, we have the stock. For stock, there is no adjustment, so we are going to write it as it is, stock 7,000, as it is given in the balance sheet. Now, next, we are going to take the furniture. Now, as per the adjustment, furniture, there is a adjustment given to us, that is decrease in the value of furniture. So, we are going to deduct the depreciation. Furniture amount is rupees 25,000 less the depreciation 2,500. So the balance amount is 22,500. 22,500. Now once the furniture is recorded, next what we have is the buildings amount. The buildings are being revalued, so we are going to write it here. 50,000 less the depreciation 5,000. So the actual value of buildings in the new balance sheet will be 45,000. And next, the prepaid insurance, which is given in the adjustment. This prepaid insurance is the expenses which is paid in advance, so it is treated as an asset. So we are going to write it in the balance sheet, prepaid insurance 2,000. So these are the entries which will appear on the asset side of the new balance sheet. Now moving on to the liabilities side, we have creditors. There is no adjustment, so we're going to write it as it is, creditors 18,000. Next we have outstanding salary 12,000, and then the new capital should be recorded here. The new capital will include the new partners, that is we'll have to include all the three partners here, including the new partner. So their capitals are Rekha is 64,800, Surekha is 43,200, Chandrika is 40,000. So the total capital is 1,48,000. So these are the entries which will be recorded in the balance sheet along with the adjustments. So the total of our balance sheet will be 1,78,000. So both the sides you will get the same total. So this is the balance sheet which we have prepared after admitting the new partner. Hope it is clear, students. We will see another important adjustment related to goodwill in the next video. Thank you.